our CPE day number 3, part 2. Of course, my name is Mike Weber, and I'm going to be co-presenting here with Dan Oberst, who's a manager in our tax services group. And we're going to be talking about the pandemic tax relief. And the two topics for today are the Paycheck Protection Program loans and the employee retention credit. We're not going to spend a great deal of time talking about the PPP loans because, at this point, everyone's sort of headed on the runway to forgiveness. But what we are going to do is talk about it in the context of how you apply for forgiveness to give you the best answer to take the employee retention credit. If everybody recalls back in March of 2020, which seems like an eternity ago, when the CARES Act was passed, of course, that was where the unveiling of the Paycheck Protection Program was, and included in there was the opportunity for businesses to take advantage of the employee retention credit. But at that point, you couldn't utilize both. You could utilize one or the other, and subsequent legislation has since canceled that and allowed for retroactive utilization of both and prospective utilization of the employee retention credit. Right now, regarding the employee retention credit, though, you can just see some items here we're gonna talk about. Dan's gonna go through some of this, a general overview, and talk about the 2021 guidance that has recently come out. We're gonna speak to some common issues that we've encountered, and of course, like I mentioned, some considerations when you're filling out the forgiveness application. And with that, we're gonna take our first polling question. And we mainly asked this question based upon what I had previously said here, in that most organizations had gravitated towards the PPP funds initially, but then again, due to some changes in the legislative text there, you could actually utilize both the retention credit and the PPP loan. I'm going to give it maybe 5 more seconds, and then we'll take a look here. Okay, so in our poll results here, we have about 22% of our participants here claiming that they utilize both the retention credit and the PPP loan. Just a couple small items here with respect to applying for forgiveness right now with respect to your second loan. As everybody probably knows at this point, the covered period for the second draw loans is anywhere between 8 and 24 weeks. And so, in the past, you had to select either 8 or 24 weeks. Now, in the second draw loans, you could select 10 weeks, 13 weeks, 15 weeks, anywhere between 8 and 24 weeks. So keep that in the back of your mind as we talk about some of the retention credit issues and how that may impact you. The forgiveness deadline, just to recap for everybody, is the length of your covered period plus 10 months. So for most organizations, we are going to be approaching the deadline for you to apply for the second draw loan forgiveness. And a change that was made some time ago, but is just important to reiterate again, is that you can spend as little as 60% of your proceeds on payroll costs. And as we talk about, qualifying wages for the retention credit, this has become increasingly important to be able to fill up your forgiveness application with some of the non-payroll costs that are out there. Now, originally, the categories that you could utilize to obtain forgiveness were very narrow and tight, and subsequently had been expanded to include the additional items that I have listed upon here. And so as you're putting together your forgiveness application, thinking about it, don't forget that all of these categories are eligible to include costs into the non-payroll bucket. And those are listed here: operations expenditures, property damage costs, supplier costs, and worker protection expenditures. So to the extent you have those categories, you can pop those into your forgiveness application under the non-payroll category. What's really important to just think about here is, how do we put the PPP forgiveness application together and integrate that with the employee retention credit? As you're going to find out here in the coming slides, you could only take the retention credit based upon qualifying wages within the quarter where you qualify. And you cannot also use wages on your forgiveness application to take the retention credit. So it becomes increasingly important for everybody to reconsider how they're going to apply for forgiveness, to utilize all of those non-payroll costs, because to the extent you can utilize non-payroll costs, it frees up more wages to be utilized for the employee retention credit. And with our second polling question, we're going to go to our second polling question. And just a comment on this question real quick. Most of the business owners that I currently am working with, I would say a large majority of them have applied for their forgiveness on the second round loan at this point. I'll give it a few more seconds and we'll take a look at the results. Okay, and about 23.6% of our answers have suggested they have applied for loan forgiveness on the second draw loan at this point. And with that, I'm going to turn it over to Dan.
Hello, everyone. Thanks, Mike. My name is Dan Oberst. As Mike previously said, I'm a manager in the tax group. And I just want to go through a rundown of some of the topics we'll be discussing in the employee retention tax credit section. First, we'll talk about some of the background and basics of the credit. Then we'll talk about some of the 2021 guidance that was issued by the IRS and how it impacted businesses and taxpayers. Again, we want to touch on the coordination with the PPP loans and how you integrate that with the employee retention tax credit. And then finally, we'll talk about, after you know whether or not you qualify, how you actually claim and take the employee retention tax credit. So just as a general overview of the credit, it was included as part of the CARES Act that was passed on March 27th, 2020. And the CARES Act allowed for a credit of up to 50% of a qualified employee's wages per employee for all quarters of 2020. And I just want to emphasize all, because as we'll talk about later, that's a limitation in that it's not a per quarter determination, it's for the entire year. After the CARES Act, the ERC was amended by the Taxpayer Certainty and Disaster Tax Relief Act of 2020. This was important because it pushed the ERC that was previously set to expire at the end of 2020 into tax year 2021. Not only did it do that, it increased the credit by 20% of employees' wages to 70% instead of 50% per employee. And it also made some substantial changes into how you qualified for the ERC in 2021 compared to 2020. After that, there were some final changes by the American Rescue Plan that allowed the employee retention credit to go into Q3 and Q4 of 2021 to expire at the end of the year. But as some of you may have seen in the news recently, with the Infrastructure Investments and Jobs Act that was signed by President Biden earlier this week, it actually eliminated the employee retention tax credit in Q4 of 2021, with the exception of a specific type of taxpayer group that can be classified as a recovery startup business, which we'll define and talk about later in the presentation. But that's something that's important to note, because some taxpayers may have even been withholding some of their withholdings in anticipation of the credit, and now that credit's not there anymore. So we'll be interested to see what type of guidance is issued by the IRS and some of those types of matters. So in order to qualify for the employee retention tax credit, you have to either have been a business that was fully or partially suspended due to an order from an appropriate government authority, which Mike will discuss later, or you need to have experienced a significant decline in gross receipts during the calendar quarter. And at first, you might think that the employee retention credit is, there's a lot of cases that can be kind of black and white and easy to note if you qualify for the credit. But even within these two categories, there's a lot of questions that get raised about what's an appropriate government authority issuing an order. And also, as we'll go through in the next couple slides, the definition of a significant decline in gross receipts is different in one year compared to the next and how it applies. So it can get pretty complicated, but we're trying to just provide a general high-level overview of how this can be beneficial to taxpayers. And with that, we'll go to our next polling question. Does your organization qualify to claim the ERC in 2020 and or 2021? Yes, no, and would you like, I don't know, and would like GYF to help me.
And with that, I saw recently that the IRS had released some information that suggested that on the 2020 payroll tax returns, which, admittedly did not include the change at the end of the year for the retroactive application, but the IRS was suggesting that the employee tax or employee retention credit was only taken on somewhere between 3 and 5% of the Forms 941, which is where you claim the credit. So in 2020, at this point, only 3 to 5% of businesses had actually claimed that credit on an original filing.
Wow, that's very alarming. Hopefully more people get out there applying for it. So a lot of businesses here are saying, no, we didn't. A lot of people on the call said, no, we didn't qualify. And hopefully as we go through some of these, you might see different ways that you could potentially qualify that you're unaware of, and hopefully maybe can look into that. So next, I just want to walk through an example of how the rules apply for a significant decline in gross receipts in 2020. So this requirement's met in the first calendar quarter in which an employer's gross receipts are less than 50% of its gross receipts for the same calendar quarter in 2019. And that period continues until what's the significant decline in gross receipt period, quote unquote, ends. And that ends when the business's gross receipts get back to a level of at least 80% of the same calendar quarter in 2019. So that allows you to continue to qualify. It kind of keeps a running clock until you hit that 80% threshold. So here I put together an example of the 2020 gross receipts roll, and you'll see that in Q2, this business experienced a decrease in gross receipts of 52%. So they would qualify, and that allows them to qualify in the next quarter too. It's basically a qualification for 6 months. And because in Q3, their gross receipts did go over that 80%, they will no longer qualify in Q4 of 2020 because they've exceeded 80% of the prior quarter. In this next example, we start out the same way, but I changed the gross receipts in Q3. So in this case, in Q2, the gross receipts decreased again by 52%. But then in Q3, we only had a decrease of 25%. But because we didn't get over 80%, we can continue qualifying through into Q4. So that gives us a whole nother quarter we can look at the employee retention tax credit. So you can see it might seem like you need a decrease of 50% every quarter, but that's not necessarily the case. So if you have one quarter that really was impacted by COVID, you might be able to continue to qualify throughout 2020. And then next, we're going to break into the decrease in gross receipts for 2021. And that's any calendar quarter in which an employer's gross receipts are less than 20% of its gross receipts for the same quarter in 2019 as compared to 2021. I just want to highlight the 2021 because that's something that's a little different than you would expect. You would expect it to kind of roll forward 2020 versus 2021. But I think what they were trying to do here was allow businesses to compare their 2021 gross receipts against their last really normal tax year in 2019 before the COVID pandemic, because if you're trying to look at a decrease from 2020 into 2021, that's not going to be probably the same kind of determination you'll get as when you were looking at 2019 when you were in full operations. And there was also a safe harbor that applies to 2021 when you're looking at gross receipts. And this allows a taxpayer to qualify based on a decline in gross receipts in that quarter immediately before the quarter you're trying to qualify in. So this next bullet that's bulleted in red is important because I've worked with some clients where we were able to qualify in Q1 of 2021 because Q4 2019 versus Q4 2020, we had a decline in gross receipts, so it allowed us to qualify in 2021. And we're going to walk through some examples now of how these rules apply as well. So in this case, we have our 3 quarters in 2021, and we experienced a decrease of 30% in 2020 in the first quarter. And because we can use that safe harbor rule, we automatically qualify in Q2, even though we have not experienced a decrease of at least 20%. And then again in Q3, we hit a 22% decrease in that middle column. So then we again qualify for the credit in that quarter. Just to provide an example of how that prior year safe harbor or prior quarter safe harbor applies, you can see in this example, I started out with the Q4 information and then Q1. And if you look at the Q1 for 2021 versus 2019, we would only have had a 5% decrease in our gross receipts. But because we're able to look at Q4 of 2020 versus 2019, we had a dip of 30%, and that allows us to still benefit from this credit in 2021 in that first quarter, even though we haven't experienced a decline of 20% in that quarter. And then kind of just rolling forward with that same example, in Q3, we would have had a dip of 22%. And consequently, even though our gross receipts are actually above what they were in 2019, we would still qualify in 2021 Q3 based on that safe harbor test. And I'll turn it back over to Mike to discuss the government shutdown orders.
Thanks, Dan. One thing I just wanted to point out before we move on to this part of the presentation is that it's actually pretty relevant discussion. And in fact, I had this at lunch today with somebody. You may not think you qualify, for the credit based upon the gross receipts, just because in 2020 or 2021, you're having what you would consider to be a normal year. You may not have been affected by COVID. Your revenue is not affected by COVID. But the reality is that you're comparing that to the baseline, which is 2019. And so 2019 might have been an unbelievable year for you. You may have had some sort of anomaly happen during that year, which when you look at the metrics for comparison, it appears like 2020 or 2021 is showing a decline. In your mind, you may think, well, this is just like any other normal year because we had some really, crazy good year in 2019. None of that really matters. It's just a straight mathematical comparison between 2019 and 20 or 21. So keep that in the back of your mind as you're trying to assess, whether you qualify for this credit based upon the gross receipts test. As Dan mentioned in a prior slide, gross receipts is one way that you can qualify for the retention credit, but being partially or fully suspended by a government order is another way. And this is where we get into, a bit of a gray area, depending on what type of order you're looking at and to what extent that it possibly has affected your business. And so the IRS has come out and said that the orders must be issued by federal, state, or local government that limit commerce, travel, or group meetings. Orders not from federal, state, or local government do not qualify a taxpayer for the employee retention tax credit. And you can see the examples down below here, and those examples are taken directly from the IRS FAQs. But I just want to take a minute to talk about this slide because what you don't see in here is a order issued by some other government. For example, Canada. Canada says that you cannot travel into their country for a given period of time. Well, that would not be a governmental order that you could rely upon to claim the retention credit. It's pretty clear, I think, in the IRS guidance on this that it's got to be a United States federal, state, or local government order. And so that particular issue has come up. The other area where this has come up in some of the situations that I've worked on is where the state or local government delegates the authority to a particular industry or organization's, oversight panel, if you will. If the PICPA says something, right? What type of impact does that have? Is that considered a governmental order? On its face, no, but if that delegation is there, it's possible that perhaps that would be a limiting shutdown order that would otherwise qualify you. I think those are some of the gray areas right now that we don't specifically know the answer to. If you're going to rely upon a government order that partially suspends your business, you had to have been affected in more than a nominal portion. And originally, nobody knew exactly what that meant, and then the IRS came out and defined what nominal portion was. And you can see down below here that gross receipts from the business segment are at least 10% or more of total receipts of the same calendar quarter of 2019, or the hours of service performed by employees from the business segment is at least 10% of the total service hours performed for the same calendar quarter of 2019. So in my mind, I look at this, and if you want to think about a golf course that has a restaurant, the restaurant may have been suspended in some way because they weren't allowed to have full capacity, but the golf was not. Now, is the suspension of that restaurant, is that rising to the level of more than nominal? Maybe in some situations it would be, but I'm guessing in most situations it would not be. A predominant amount of the revenue that a golf course would have is probably related to the golfing and not the restaurant that's associated with the golf course. Another issue that we have seen pop up from time to time is claiming a partial shutdown based upon your supplier being shut down. And there are FAQs and IRS guidance on this particular issue, and you can claim that your business has been fully or partially suspended if your supplier has been fully or partially suspended based upon a government order. But what the IRS has also said is that you cannot be partially suspended if your customers were suspended. And they do expound upon that in much of the guidance that they have. They're strictly saying that if it's a supplier-related issue, that's okay to rely upon that. But if your customer is shut down, that's not okay to rely on that. And presumably that provision is in there because if your customer is shut down, we're really comparing the gross receipts at that point to determine whether you've had a significant decline or not to qualify for the credit. Here's another issue that has popped up more recently. And if you could just think in the back of your mind about, the step-by-step process that you should be going through in order to determine whether you qualify, the first step you have to get over is whether you've had a decline in gross receipts or whether you've been fully or partially suspended by a governmental order. If you can't answer either one of those questions in the affirmative, then you can stop right there and you're not going to be able to qualify for the retention tax credit. If you answer either one of those questions, yes, then you have to assess what types of wages are going to be qualifying wages for purposes of this tax credit. And the rules are a little bit different in 2020 and 2021. In 2020, you could not have had more than 100 full-time employees during 2019. And there are specific rules on how you determine whether you have a full-time employee, and it's all based upon the Affordable Care Act rules of working approximately 30 hours a week. However, if you have more than 100 employees during 2019 and you qualify for the credit during 2020, you can still claim the credit based upon the wages that you pay any of your employees to not provide any services to you. So there is somewhat of an avenue for employers to be able to utilize the credit, even if they're larger than 100 employees. In 2021, that number shifts from 100 to 500. And so the government is permitting much larger employers to be eligible for this credit. Now, PPP number 2, and forgetting all of the special rules that are in there on how some businesses may qualify even if they have more than a certain number of employees. Essentially, PPP number 2 was set at a 300 employee count. And so during 2021, let's assume you have 400 employees, you would have been knocked out of the PPP loan application process, but you would still be eligible for this employee retention tax credit. And the way that you count individuals is, albeit slightly different, but nevertheless, the point is still out there that if you're an organization that has somewhere between 300 and 500 employees, and you didn't get PPP number 2, and you haven't taken the retention credit, perhaps you want to go back and revisit that because there could be some money on the table there for you. There is an exception to the large employer rules, and that is for severely financially distressed employers. And those are employers that have seen a 90% reduction in their gross receipts. And as I had looked at this slide in the last couple of days and had thought about this over the last couple of months, couldn't really come up with anybody that would fit this classification here. Perhaps it's out there. It seems like a well-intentioned type rule, but I really couldn't think of a particular industry where this is occurring. Perhaps maybe in the Q&A or somebody may be able to make a suggestion there, but nevertheless, this is out there and would exempt you from the large employer rules. In addition to qualifying wages, for purposes of calculating the credit, you can also include as part of the wage computation the health plan expenses that you pay on behalf of your employees. And the IRS FAQs clearly delineate that health, vision, and dental insurance paid on behalf of your employees are qualifying expenses. So you get to include those in part of your computation. I'll kick it back to you, Dan.
Okay, thanks. So this is something I kind of touched on earlier, and I just wanted to go through it in more detail, but there's differences in the maximum amount of ERC you're eligible to claim in 2020 versus 2021. In 2020, you were limited to $5,000 per employee across all the quarters of 2020. So essentially, you're limited to credit of up to $5,000 per employee. And some of the clients I've worked on with this, and we're calculating the credit, we needed to go through and make sure we were cumulatively not taking more than $5,000 for employees that, then max out in one quarter. So because of that, we had to cumulatively make sure we weren't exceeding that. However, in 2021, the ERC is limited to $7,000 per calendar quarter. So you're able to get that $7,000 per employee per quarter, so you can get up to $21,000 per employee in 2021 based on the recent axing of the Q4 ERC. And this is kind of something weird that Mike and I have dealt with, where on the payroll tax reforms that you're claiming the ERC on, there's a certain portion that's classified as refundable or non-refundable portions of the ERC. And for a period up until June, it was essentially the Social Security tax liability of the applicable wages at 6.2%. And then throughout the rest of 21, it changed to the Medicare piece at 1.45%. It's really just kind of a formulaic thing that if you're applying for the ERC, it doesn't limit it, but it's just kind of a clerical thing that's required as part of some of these claims for the ERC. Another thing that was created that can be beneficial to some smaller taxpayers are businesses that were started in 2020 and that meet the definition of a recovery startup business. So these are businesses that began after February 5th or 15th, 2020, and their average annual gross receipts of the employer don't exceed $1 million. And then the final point that's kind of pretty important is that is not otherwise eligible for the ERC due to full or partial shutdown or the decline in gross receipts. And that's because if you are a recovery startup business, then the credit is limited to $50,000 per quarter. So that's kind of a big limitation compared to some of the other numbers we discussed earlier. And that's why you wouldn't want to really be classified as a recovery startup business in a quarter if you're able to qualify for the full ERC, because then you're not limited and can claim a larger employee retention tax credit. And with that, we'll go to our next polling question. If your organization did receive the ERC for any calendar quarters for 2020 through 2021, what was the total amount of the credits received? And we listed some different ranges there for the potential credits. I know, like for some of my clients, that they've ranged all across the board from $50,000 to over $900,000 in a single quarter. So it can definitely be some large amounts of money that people are eligible for. Give it a little bit more time. Okay. So for this section, it looks like we have a lot of people that weren't sure of the exact amount they might have qualified for, but as you can see, it's all across the board for the different credit amounts here. And there could be potential for a lot of people to get more money, as we've talked about. Turn back.
Thanks, Dan. I'm going to go back to one of the recovery startup slides here, because I think this is really important, just to highlight a couple things here. First of all, as Dan had mentioned, you had to have began your business after February 15th, 2020. Now, why is that important? Well, that's important because if you started your business after that date, you were knocked out of applying for the PPP loan. So you would have had no option to be able to get that government funding. So now you do have the option to claim this credit, and we are in obviously the fourth quarter of 2021 where you can obviously utilize that. And if you didn't utilize that in the third quarter, you can go back and reclaim that credit. And I thought this was particularly important because I was at an event actually on Tuesday, and this particular individual had started their business in very early 2021, and I had asked her about how things were going, and they were going pretty well for this particular organization, and I mentioned to this person that they were considered a recovery startup business, and she really didn't know much about it, and upon that looked into it and really thanked us here at GYF for mentioning that to her, and she's going to be able to go back and get close to $100,000 worth of tax credits based upon the wages that she's paying her employees. So this is a little known thing that's out there, and obviously the you have to have less than $1 million in gross receipts on an annual basis. So I think that it's obviously meant for smaller employers. And sometimes those smaller employers, some of these things perhaps they miss, and not passing judgment on anybody, but nevertheless, this is out there. And so, if you know of anybody that fits these qualifications and has decided to take the plunge to start their business during COVID, just know that this benefit is out there for them. Okay, I'm just going to move forward to where we were. This slide right here, I'm going to spend a little bit of time on talking about this because this is probably one of the most important components to this presentation and understanding the integration between the PPP forgiveness process and claiming the retention credit. As many of you probably know, you can utilize as little as 40% of your PPP loan on non-payroll costs. And we talked about what some of those may be and looked at some of the expanded expense classification categories. At the time of applying for forgiveness on the first loan, or if you were applying for forgiveness very early on in the second loan process, you would not have known what the IRS was having to say about the integration between what your PPP application looks like and how that applies to the retention credit. And so in a very, very recent notice, they have come out and expounded upon this point. And they have a number of examples that play off this basic question of what does that forgiveness application mean for purposes of the retention credit. Now, I just have a couple examples that I wanted to point out here. First and foremost, I would say the number one question that we had originally was, if my PPP loan was, let's just say, $1 million, and my covered period had wages of $5 million, am I going to be limited in some way if I put all of those $5 million of wages onto that PPP forgiveness application? Or should I just put $1 million on there and preserve the other $4 million to be able to take the retention credit? That really was an important question some time ago. The IRS has come out and said, you're only deemed to have used the payroll costs up to the total amount of the PPP loan. So in that example, that excess $4 million would be available for you to use for purposes of claiming the retention credit. And that's a really, important point. So if you've already filed for forgiveness, go back and reevaluate that in light of that rule that has recently come out. The second example relates to if you've placed non-payroll costs on your forgiveness application and payroll costs. So using kind of the same fact pattern, if I had $1 million loan and I popped in $200,000 of non-payroll and $5 million of payroll, the IRS has said you're first deemed to have used the non-payroll costs that you have listed on there. So I'm first deemed to have used $200,000 of non-payroll. And then if you think about those two examples together, I've got $800,000 of payroll costs that I need to utilize on my forgiveness application in order to get total forgiveness, and thus the remaining $4.2 million is left over for the retention credit. You cannot go back and amend your PPP forgiveness application. That's one thing that we do know. So you're stuck with what you've placed on that form. However, if you haven't applied for forgiveness, think about those rules in light of whether you're going to claim the retention credit, because it really does not require a lot of thought to fill out the forgiveness application. As I understand it, the way you would do it essentially would be to include as much in the way of non-payroll costs as possible, and then just include all of your payroll costs as part of the forgiveness application. Because again, you're deemed to have used the non-payroll costs first, and you're not precluded from using those excess wages on the forgiveness application to take the retention credit. That is probably one of the top questions we're getting right now with respect to, if I've already filled out my application, what does this mean in terms of how I take that retention credit? So that's one of the things that if people on this call or webinar have questions about that, Dan and myself and other members of the tax services group can explain and consult with you on that to help you better understand the limitations that may be out there for you based upon how you filled out your forgiveness application. Another FAQ that's out there relates to commonly controlled groups of corporations or other business entities. The one thing that you have to think about here is the IRS considers common ownership to be treated as a single employer. And there are specific rules on how you determine whether you're part of a controlled group or an affiliated group. But the reality is that if you check off those boxes, say, for example, I 100% own two different businesses, I have to treat those businesses as if they are a single employer. And then I do the testing. I do the gross receipts test as if I'm a single employer, or I do the government shutdown test as if I'm a single employer. I calculate the credit as if I'm a single employer. I do all of the things and thinking about things based upon there being this fictitious one entity that's there. You still have to claim the credit on each business return, but the computation and the assessment of the qualification is looked at as a single employer. And so that's one of the things that has tripped up some people out there, I know, in conversations that I've had throughout the course of the last year or so, in trying to analyze whether one business or another business qualifies for the credit if there's common control. And again, if you meet those qualifications, you have to treat everything as if there is only one employer. So that's another thing that you just have to keep in the back of your mind. The only way to claim the retention credit is, as Dan mentioned, against payroll taxes. And so the credit itself actually shows up on the Form 941. And if you haven't included the credit on your original 941, you have to go back and amend the 941 and file the 941X to claim the credit. Unfortunately, and if you've talked to us over the course of the last couple months, it's really important, or was really important, to try to claim that credit on an originally filed Form 941, for the simple fact that those forms can be electronically filed and into the IRS system. And so those refunds were initiated, processed, and mailed in somewhere between 4 to 5 weeks. As you can see here, the 941X is required to be paper filed, and it cannot be e-filed. And since it has to be paper filed, you got to mail it into the IRS. And right now, the processing time by the IRS is at least up to 16 weeks and potentially more. I have at least a couple of situations where we had mailed in the 941Xs in February of this year, and we still did not have those refunds at this time. In the instructions, and I don't know whether this matters too much, but this is some of the positions that we have taken and counseled our clients on, is there's a general PO box that you can mail in the 941X to, but there's also a private delivery address that you can mail the returns to. And so we try to certify mail everything and send it to that private delivery address. And in some cases, I feel like that has sped up the process and we've gotten into the system faster as opposed to going into the general inbox that the IRS has. But in other cases, it's taken substantially longer than 16 weeks. So I have mixed feelings on whether that really works or does not. But that's just, it's clearly in the instructions that you can do that. And so for the mailings that we have done, we have mailed those all to that private delivery address. There is one question in the chat here that I think I could just easily answer before we move on, and that's, does the recovery startup business credit still apply for the fourth quarter of 2021? And the answer to that question is yes. So even though the president had signed the infrastructure bill, which eliminated the fourth quarter credit for all other businesses, if you're a recovery startup business, you still can claim that credit for the fourth quarter of 2021. With that, Dan, I will send it back over to you.
And this is just a polling question we have. We were curious to see what other people are experiencing out there, to see if the private delivery service has made a mark or if other people have mailed it elsewhere. But so we'll give you some time on this. And there's another question in the chat about related parties with the recovery startup business. I haven't seen anywhere in what I've read that it's treated in any other way than the employee retention tax credit. So I believe the same rules related to related parties would apply to the recovery startup business. Give it just a few more seconds. So it seems there's a mixed range, and then large group of people that say, I don't know, and that's probably because it's been so long, they can't remember when they filed it. And back to what Mike said regarding the payroll filings in Form 941, the 941X is an amended tax return, and that means that we're changing a payroll tax return that's already been filed. And one of the things that's been made crystal clear in the guidance issued by the IRS is that if you amend a payroll return, you have to go back and adjust your wage expense by the amount of the ERC received in that quarter or period in which the wages were paid. So this means that if you filed a 2020 payroll tax return to claim the ERC now, that you have to go back and amend your 2020 tax return in order to properly account for that reduction to wage expense. And this is pretty significant to a lot of businesses, because if you're a pass-through business or something like that, that doesn't just mean you're amending your business return. You're amending your payroll return for the ERC, you're amending your business return for the wage expense, and ultimately having to amend your individual income tax return when you get your amended K-1. So it ends up being a pretty big burden to some of these taxpayers out there that are claiming the ERC in a past quarter. And then another issue that's come up and kind of been something that's been contentious, or I think there's been a lot of pushback on this, is the related party rules and how they apply to the employee retention tax credit. Currently, the way the guidance has been issued, a corporation's majority owner and his or her spouse may only be considered for qualified wages for the ERC if certain conditions are met. And essentially, those conditions are that you don't have a brother or a sister, an ancestor, or a lineal descendant. And that's a very broad net, and it's very strange. And it also includes people, even in the FAQs, they'll attribute the ownership to these related parties, even if they don't actually work or have any other relationship with that company. They could still pull in an owner as a related party and therefore disqualify that owner's wages from the ERC. In the case where this may be this perfect scenario where this majority owner and the spouse don't meet these requirements, then both this husband and or wife or spouse can both qualify for the ERC and take that on their payroll return. So it's a very strange rule. I think there's been a lot of pushback. It would be great if in the future there's some guidance to kind of correct that or fix that in the future. And it's back to you, Mike.
Okay. Just wanted to comment on a couple comments and questions that we have in our Q&A right now. One particular person has messaged in that said the AICPA has said that the IRS processing time on a 941X is currently sitting at 8 months, which obviously is more than 16 weeks. Part of what we base our timeline on are the returns that we've filed thus far. And so, if we file a return 4 weeks ago, we've yet to see, obviously, whether that refunds come to be, and I guess we'll have to update our timeline. I'm not doubting the AICPA or the person putting it in here that says that we're sitting at 8 months. If that is the case, that's interesting, because that's a significant period of time, given the amount of money that's at stake here. And to just take it to our next question to kind of tie these in together, another person saying, are you saying that the ERC reduces your wage expense for the tax return? That is, in fact, correct. The problem is that if you're a cash basis taxpayer and you're retroactively claiming the credit, let's just say for 2020, you don't actually have that cash. Perhaps you have $1 million credit and you've taken that wage expense on that return. Theoretically, you're supposed to go back and amend that return, reduce your wage expense by $1 million, rerun all of the income tax returns, and pay the appropriate income tax associated with that. That all would be happening before the 8-month processing of that 941X. So you'd basically be incurring that tax bill before you have that cash. That's an interesting concept, but the IRS has come out and said that is their position on how this should work. So if you find yourself in that situation right now, that is how you're supposed to proceed. I wanted to go back to one slide here, and that just claiming the ERC for past quarters. Dan and I had a conversation not too long before we came into this presentation with respect to what happens in the event of a business transaction where you have new ownership. So in 2020, you had owner number 1, and in 2021, you have owner number 2. And owner number 2 wants to go back and claim the credit during 2020. Well, first of all, can you do that? second of all, what are the ramifications of doing that? And those are some of the issues that we're working through right now. I would say, to a large extent, a lot of the low-hanging fruit retention credit calculations and projects are sort of over and done with to some degree. The ones that we're looking at right now are definitely touching upon much more of the gray areas. That sale of a business example, what can or can you not do with respect to that situation? I just had a conversation with somebody this morning about a litigation law firm and whether they could have been considered partially suspended by a government order where the government had restricted court access, and so there were no trials occurring, and some of the issues surrounding that. So you think these things are cut and dry. Some of them are, some of them aren't, and you can see a flavor for some of what we have out there and some of the discussions that are taking place right now. Just some closing thoughts here. Of course, as I had mentioned, the second round of the PPP loans, those covered windows are over. They're coming to an end or are over. And so right now, you're really in a position to be applying for that forgiveness. If you think that you've got the retention credit sitting out there, just remember you can go back and amend those payroll tax returns for up to 3 years. There is a statute of limitations there, but you do have a considerable period of time to go back and reevaluate what was done, or a year from now, perhaps you learn a little bit more, or you find yourself in a situation where, hey, I just want to see if this particular organization claimed that credit, or if they did claim the credit, did they properly reduce that wage expense on the business tax return? So there's a lot of things to really think through, and this is something that we're going to be keeping our eyes on for the next couple of years, just given that statute of limitation issue. If you think about it, the third quarter 2021 return was due, payroll tax return was due roughly Halloween, October 31st. So you'd have 3 years from there. We were all the way out into 2024. So we're going to definitely continue to look at this and continue to pay attention to it. And of course, the last closing thought here is that just remember that you cannot utilize the same wage for forgiveness you cannot utilize the same wage for forgiveness that you're going to use to take the credit. So it's really important to understand how you're filling out your forgiveness application for PPP number 2. With that, I think we've answered a number of questions here, and here's our contact information and Mary Lou's contact information and such. Dan, I just wanted to give you an opportunity to mention an example or two, if you have one that you wanted to talk about.
Well, thanks, Mike. First, I wanted to just bring up, too, I think it's important when you're considering whether or not you qualify for the employee retention tax credit in the next couple of months that you really consider if you qualify for 2021, because you don't want to be in a situation where you do qualify for this credit and can be applying for it now, and then you file, on time in 2022, and then you might have to go back and amend that income tax return for something that you could have proactively handled now and reduce the wage expense. That could just create additional compliance costs and accounting fees that don't need to be paid if you can get a jump on this and make sure you're accounting for it and claiming it now. Some of the different other kind of gray areas examples that I've had to deal with is an example where maybe one organization uses facilities at another organization and they're unable to go to where they need to use the facilities because of some government shutdown order that's being applied to the organization that owns the facilities, and whether or not that might qualify as a government shutdown order. So in cases like that, it's, we requested an assertion from that organization that they were impacted by a government order, and that's why they were unable to get to the facilities. Just trying to look at some of the other questions in here. One question I see here, Mike, is to determine gross receipts for a nonprofit, is it cash received or does it include grant funds promised? I'm not sure I've seen that, but I believe you would follow whatever accounting method you use. So if you're reporting on an accrual basis, I would assume that that's included. I don't know if you have any other examples you want to chime in with, Mike.
Yeah, just to comment on that one. So, yeah, if you have on the nonprofit side, it's cash received, but then you also have to pay careful consideration to any investment transactions that you have, because those would also be included as part of your computation. There's one other question here with respect to the covered windows on PPP number 2. So it is anywhere between 8 and 24 weeks, and in order to apply for forgiveness on time, you would be looking at whatever that day is that you apply. I'm sorry, it's your covered window that you select, anywhere between 8 and 24 weeks, and then 10 months after that. That's the date where you have to apply for forgiveness before you would start racking up the interest. So I think that takes care of all the questions that we have in the chat. And with that, I'm going to turn it back to Mary Lou for final administrative and housekeeping items.